Hi, this is Vinney Chopra. Thank you for again joining on my podcast, Apartment Syndication Made Easy. As you know, I wrote that book, which is a top seller in Amazon. Internationally also got a lot of acclaim, reviews and all. And this podcast is about syndication, about commercial investing. I like to bring great guests for you and dig into their story, their successes, and find out some nuggets from them so that you could really enjoy them and learn from them and then implement them. All right, guys, this is Vinney Chopra back again with the Syndication Made Easy podcast. As you know, you're loving the content. A lot of your comments have been so great. I appreciate you, everybody. And my abundance mindset with Vinney Chopra on Thursdays. We had a peak today, and this is so exciting. We had 3,000 impressions, just in short while. So thank you. And again, my third book is coming. Positivity Brings Profitability is my second book, but the third one, Senior Living Investing, is coming very soon. So I have a great guest here, Aaron Fragnito. Hi, Aaron. How are you? From New Jersey.
Hi, yes. How you doing, my friend? Good day.
I'm doing good. Aaron, just to let you know, he's in syndication business, in real estate also. He's done 250 plus transactions and 50 plus flips, fix and flips, and also 100 wholesale deals. So got a lot of experience, and then 9 syndications he's done and 100 plus properties sold. So I'm very excited to have him. Tell me more, Aaron. How did you grow up in New Jersey, or tell me a little bit more about you? Yeah.
Sure. Yeah, absolutely. Jersey boy, born and raised, went to Watchung Hills, grew up just outside of Basking Ridge, and absolutely. I remember my dad owned a condo in Middlesex County, actually, around in where Edison is. And I went to help him paint it between turnovers and stuff. And I wanted to own something like that, this big apartment complex. I didn't really know how it worked as a younger boy, of course, but I always knew my passion was to own something like that and build wealth. So, I read a book called Rich Dad, Poor Dad in college, and that really set me on the trajectory of learning how the rich get richer and how, wealth is actually created and built over time using assets and using good debt. Then I learned more about that and tried to just get into the industry as a realtor. I started there as a realtor around 2010 after I graduated from college. And boy, it was just a terrible market. It was a terrible, no one was buying houses. You'd list a home on the market. No one would call you. So what I had to do was learn short sales and foreclosures, because that's basically what was going on at the time. Yeah. So I learned how to do short sales and get them for really great prices. I learned how to buy REO properties and connect with banks and things like that. Investors started to really like me because I was the deal guy. I had a bunch of deals coming in and I made commissions on them. The investors liked me. I was happy. So over time, I built those relationships, and those investors started investing in me and buying properties with me and my business partner, Seth Martinez. And there's a million stories in between, but that's how I got started.
Excellent. So how was your transition? You went from a wholesaler and a flipper, right? A lot of people are entering into multifamily. I'm into into hotels, into crypto mining. I mean, you name it. I'm into a lot of senior assisted living, ground ups, all that stuff. But how did you make that? How hard was it for you to do your first syndication? Let's go to that.
Oh boy, yes. Well, being a realtor, being a wholesaler, being a fix and flipper is completely different than being a real estate syndicator. It's completely different. So what I had to do was basically retrain my brain and my sales strategy and my relationship process, and market and rebrand my company in a big sense. We were fix and flipping a lot of properties. We started in 2013. We bought a 25 unit property, raised capital, bought a 25 unit property. And right away, we went right into another deal and started to raise capital for that. And what I realized was you need to build relationships and have those in place for some time before you can ideally start to raise large scale capital and do a syndication every 3-4 months, and quite frankly, probably, kind of came out of the gate pretty quick there. And then we did well in the 25 unit, but we realized, listen, if you want to keep syndicating every 4 to 6 months, you actually need to build a fundraising machine.
Yes. Could you take us into that? I know our, advanced listeners and beginners also in my whole quorum. So how hard was it? Did you make some PowerPoint presentations? How did you get started with your first investor? What kind of questions did they ask you? Can you take us back there?
Sure. So the first private capital I raised.
Hi, you are listening to Syndication Made Easy podcast. We will be right back after this short break.
Hi, thank you so much. This is Vinney Chopra, and thank you for subscribing to my podcast and YouTube channel and Facebook pages and all the great things, and LinkedIn. Connect with me. I come live to you every Friday at 9:30 Pacific with Vinney and Bo show. Please also look at that. And also the podcast, which is my apartment syndication made easy. The book I wrote a couple of years back became international top seller on Amazon International now. And then we like to bring great guests for you every week or twice a week sometime to give you a lot of great knowledge. So please subscribe. You give us 5-star reviews on the iTunes. The better the guests we can bring, and our ranking will go higher also. Thanks again for following us and really getting the most out of it. Please comment, like, share, because we would love to bring better and better material for you.
So the first private capital I raised, I went to a RIA, a real estate investment group, that on meetup.com. I just searched on Meetup, RIAs near me, and they're all over the place. So I went to one of the most popular ones, and I made a beeline for the owner of it. I said, hey, I'm a new realtor. I have 14 short sale listings. I help investors buy fixer-uppers, and I want to talk to you about how I got started in this business. And the topic's going to be fake it till you make it. So I did the presentation in front of the group, fake it till you make it. I've always loved public speaking, but so I actually, 2 people in the crowd liked what I was saying. I was new. I was probably a high risk investment, and I had a flip going on. Actually, my father had invested in that flip. So the first capital I really did raise was actually from my father. So we did all right on it. We learned a lot, but we actually ended up breaking even. So it was a huge learning curve. But then I started raising private capital outside of that, and I was able to start raising it more in a debt position, so investors would get an interest rate, and that was easier because, quite frankly, a new operator, you say to your investor, hey, I'm gonna hit the mark, I'm gonna do everything I say I'm gonna do, and but you're a new operator, so it's really a high risk, and you're not a proven track record yet, like we do now. So most investors were like, what, I'm more comfortable in an equity debt position, okay, first lien position, or even a promissory note, a personally guaranteed promissory note.
Yep.
And getting started, I paid an 18% interest rate to invest.
Wow.
Oh, I paid to play. Absolutely.
Yeah.
But, I used that capital to do fix and flips and wholesales where the profit margins were, 2x or so on the money, right? Very aggressive returns. So I was able to pay that 18% interest rate because I was making multiples up more than that. So, but over time I recognized, it's not a sustainable strategy really with the high interest rates. So I started borrowing capital at lower and lower interest rates, eventually down to 10% or 8%. And then over time we recognized, we kind of got off track. We started fixing flipping homes. We did 50 of those. We made some money. We also learned high-end flips are much harder than low-end flips. And we did very well with low and mid-level flips. And then we hit a lot of headwinds with $1 million flips and recognized, you can make money flipping. You can also lose money flipping.
Lose money, yeah.
We, made sure our investors were made whole, and they made a nice 12% annualized return on their investment. But we learned a lot flipping houses, and we had some wins and a couple losses there. We did a lot of wholesaling. We went to sheriff sale auctions, 2016, 2017, 2015. There were great deals. We would scoop up properties for $30,000, put them under contract, put down the 20%, call up our buyers, sell them the property for $100,000, make 70 in between, right? Crazy profit, made hay while the sun shined. And then, the wholesale deals started drying up. The fix and flip market got harder and harder. The profit margins got thinner and thinner. So we started saying, you know what? It's hard to scale fix and flips. It's hard to scale wholesaling. It's not always a predictable marketplace for both of those. And what's easier to scale and more tried and true is apartment building complexes and just general real estate buy and hold strategies where you buy for a great price, fix it up, rent it for top dollar, refinance, cash flow, refinance, repeat.
Totally. It's like the mixture of,